This is Don Durrett, the Feneck Commodity Report, and today we have Alex Scanlon with Barton Gold. John can't be with us today, so I get the pleasure of interviewing Alex. I've actually met Alex before. Liked the story. First time I heard the story, I basically bought into it a while ago. So now you guys get to hear the story. So we got 30 minutes with Alex. So Alex, I'm going to turn it over to you and let you. I don't know if you have any slides today. If you don't, it's all right. But yeah, give us about a 10-minute overview, and then I'll just start asking questions.
I do. I've got an updated, sort of an abbreviated version of our presentation. Just a quick refresher for anyone who maybe isn't up to date on the story. Barton Gold is a pure play gold developer in the state of South Australia in Australia. So South Australia is very interesting. It's the home of the Gawler Creighton, the home of the IOCG province that BHP Billiton has consolidated, and that mineralized basin that hosts this very deep copper resource trends to surface as it heads to the west, and it becomes sort of shallow and goldy. So from deep and coppery to shallow and goldy. And we saw an opportunity going back to 2017 to essentially consolidate the entire historical district, which we did. Spent about 3 years acquiring every significant historical exploration and producing asset. We acquired the only gold mill in the region, and then we stepped back. And the idea was to build up a much larger development platform so that we could go back and leverage that mill not only to start operations, but as a stepping stone to something much bigger. So we're not targeting 50,000 ounces per annum. We're targeting 150,000 ounces per annum. Now, since you and I last spoke, we have made a significant number of large strides in that objective, namely demonstrating that the Tunkillia project, that stage 2 scale asset for us, will produce about 120,000 ounces per annum on average of gold, 250,000 ounces of silver, and actually pay itself back 2 times over in the first year. So very, very strong scale asset. We've now gone back up to what we call our stage 1 area, our central Gawler mill. And the plan is to transition that into operations, get that going, and use that cash flow to fund the development of Tunkillia. So getting to that large scale objective with a small scale investment up front, because our central Gawler mill is fully permitted, existing, and we can basically turn that on with a refurbishment check instead of building a new mill. So during the next 18 months, we have quite a lot going on. We have recently grown JORC resources at the mill. We're going to grow those again pretty imminently. That's something we forecast to the market, so I'm not saying anything I shouldn't. We're going straight to full feasibility to do a 2-phase startup of that, 1, processing tailings, and 2, high-grade fresh rock mineralization. And in parallel, we are advancing that project at Tunkillia toward development, also targeting feasibility in a mining lease application by the end of 2026. We've also made a very interesting high-grade gold-silver discovery, and we've acquired another gold project. So these form part of our regional strategy to essentially satellite blend or satellite feed high-grade mineralization into our 2 mills and continue to leverage that infrastructure. Our capital structure is very simple. Since we've spoken, we've barely issued any equity. In fact, we've only issued $13 million Australian worth of equity in the past 4 years. So we have about 225 million shares on issue. We have an enterprise value of around $200 million Australian. And importantly, we have a very high degree of consolidation in our register. So board, management, and institutional investors own over 50% of the company. Another quarter is owned by sort of proper high net wealth and family office. And about 20% of the register is owned by retail. And there's 2 key takeaways here. One is the consolidation of our register into the hands of institutional shareholders and family office high net wealth shareholders. This has followed 1, very strong alignment with board and management, and 2, really consistent, low cost, high efficient progress. And the other key takeaway here is that notwithstanding the fact that we have such a highly consolidated register, we actually have very high liquidity. So we trade like a company that is much larger than us in terms of our daily liquidity. The 20% of retail that we have is actually 3,000 to 4,000 shareholders. So we have high concentration, simple decision making, but also high liquidity. And one of the ways we've been efficient is to generate income from our assets. So we do this by literally scrapping out and trading steel and copper. We produce and sell gold concentrates. We rent our camps and infrastructure to third parties operating in the region, and we make ample use of tax and grant programs. So this has actually generated more money internally than we raised externally for the last 4 years. The capital structure obviously is not complete, nor does it even start without considering the human capital. We have a team in Barton Gold that was built to be a multi-billion dollar business, in a manner of speaking. We have our leadership team with several hundred years of experience in finding, permitting, building, financing, and operating major mining assets, with a particularly strong pedigree in gold and in South Australia. So in terms of gold, half of our leadership team comes from Normandy Mining, which many of your investors may know was the largest gold producer in the Southern Hemisphere in the 1990s until it was acquired by Newmont in 2002 as a 2.5 million ounce per annum producer. So roughly 1/3 of Newmont's entire current portfolio would be represented by that Normandy acquisition. And the second aspect here is that our team is entirely in South Australia, with the exception of one non-executive director. So a lot of native South Australians are long-term South Australian residents. I'm the youngest resident at 6 or 7 years. But people who are very serious about South Australia and doing something big in South Australia for South Australia. And that, of course, is very important in our alignment with local stakeholders, including government. When we put this on a map, as we mentioned, Tunkillia is, which you can see here, this is really the scale destination, right? So this is what we call our stage 2 project. Now, we've just demonstrated that that will produce 120,000 ounces per annum gold, 250,000 ounces silver, and pay back very, very quickly. So this is a very attractive institutional scale target. Again, it's that target of consequence that we wanted to create. And now we're saying, hey, we just put that study out in May. We said, hey, don't forget, we actually own an existing mill. We own existing brownfield mines. And we are now moving this Challenger mine and our Central Gawler mill into feasibility studies, targeting the initial start of operations by the end of 2026, and essentially our first full year of production during 2027, where we start producing 20, then 30, then 35, then 40,000 ounces per annum. We generate cash flows, we re-rate the equity profile and the credit profile of our company, and then we go and develop Tunkillia when that's ready to go. In parallel and alongside these things, we have our Tarcoola project. This is this project here between the Challenger and Tunkillia project and our newly acquired Wudinna project. And in a manner of speaking, what will happen is we'll have hub number 1 at our Central Gawler mill here at Challenger. We'll have hub number 2 at our Tunkillia project. And then Tarcoola, which is the historical high-grade gold field in South Australia, that will feed high-grade gold up to our existing mill, down to our Tunkillia plant. And then Wudinna, we will likely produce a concentrate that either or both of goes directly to market at our neighboring ports or up and into our Tunkillia project. The objective here and the thesis behind our Tunkillia project is to create, in a manner of speaking, the Capricorn Metals of South Australia. Now, we reference Capricorn because these guys really are the market leaders in large-scale bulk open pit low-grade gold. Traditionally, the Australian market tends to be thought of as a deep, high-grade underground gold mining market, and by and large, particularly in Queensland and Western Australia, it is. But Capricorn Metals actually bought and developed a project called Karlawinda just as we were doing our diligence on Tunkillia, and it actually gave us some early clues into how we thought about Tunkillia, how we'd advance it, how it might be developed. They bought this asset as a 650,000 ounce asset in 2015. Then they grew it to 900,000 ounces and 1.1 and 1.3 and 1.5 million ounces and focused on scale development. Today, it's a 2.2 million ounce asset, but has a 0.7 gram per ton resource grade. And a lot of people say that's a low grade resource, but today, processing 4.5 million ton per annum, they are producing 120,000 ounces per annum. They're one of the lowest cost gold producers in the market, and they're a $4 billion company. We acquired our Tunkillia asset just at the beginning of 2020 as a 550,000 ounce asset, grew to 900,000 ounces and 1.1 and 1.3 and 1.5 and now ultimately 1.6 million ounces. And we've demonstrated that it will actually outperform these cost metrics at the Karlawinda project during its first few years. So we have now basically sort of set the agenda. We've set the target here. Tunkillia is the scale. And now we're going back and looking at leveraging our Central Gawler mill to kick it all off quite cheaply. So when we look at the Central Gawler mill, you can see here essentially an engineering scan showing various of the components that we're going to replace and upgrade. This is a fully permitted mill on fully permitted mining leases with brownfield open pit and underground mine, high grade open pit materials running between 3, 4, 5 gram per ton, open pit and underground, with very strong historical recoveries. So very simple mineralization. We've just updated our resources to 223,000 ounces. This includes 100,000 ounces in high-grade open pit and underground material, It also includes some high-grade tailings. So we have an historical tailings facility where there's an outer ring of material that grades up to 1 gram per ton. And this presents a really interesting opportunity to actually just regrind that material because it's very coarse and essentially cheaply kickstart operations here, defer a lot of capital costs in terms of the crushing and grinding circuit, get the site into operations, and then optimize the crushing and grinding circuit and bring in fresh ore and go from producing, say, 20,000 ounces in the first year to 30, 35, 40,000 ounces by increasing the average feed grade to 2.5 to 3 grams. Now, importantly, we actually put out a study earlier, I should say earlier, it was 2 months ago, in July, indicating that the cost of reinstating the Central Gawler Mill to its full design capacity for fresh ore would only be about 26 million Australian dollars, or call it 17 million US dollars. So this is a very, very cheap drawbridge to cross in terms of getting into operations. And obviously that means the size of the prize, re-rating from where we are today into operations, is both significant and highly accessible with very little dilution. And of course, we have been approached by a number of groups interested to provide non-dilutive financing. We do, after all, have an existing fully permitted mill. So we are now moving this straight to feasibility, targeting operations at the end of 2026. In parallel, we are advancing this Tunkillia platform, and we've actually expedited some of the early stage environmental studies that will allow us to accelerate mining lease applications and then bring forward financing conversations and ultimately develop. This is a project, again, the one that we acquired as a 500,000 ounce asset, and we've now grown it past 1.5 million ounces. And by all accounts, it looks like a fairly standard, kind of mid-cap company style asset. 120,000 ounces of gold per annum, 250,000 ounces of silver as a byproduct. AISC is about 2,200 Australian, or about 1450 US. So that puts it sort of middle or just in the bottom half of the global cost curve. But where this gets interesting is when you look at, for example, the free cash flow from operations in the NPV, these look sort of standard for this style of project. But where it gets more interesting is the returns profile here. So 73% equity IRR and a 0.8 year payback period. And this is because this asset, and one of the interesting features about it that we identified, has a higher grade central zone of mineralization in this very broad bulk mineralization. The result is that the sort of stage 1 pit that we have here produces around 200,000 ounces per annum in the first year, effectively driving the cost per ounce down to less than $1,000 Australian, or 650 US, and generates about $800 million in free cash flow from operations during the first year alone. So it pays itself back 2 to 1. And we are now bringing forward all of our long lead programs here: water, flora, fauna, accelerating feasibility and mining lease applications. So in parallel with starting operations at our Central Gawler Mill by the end of 2026, we want to have this basically applied for and on track to also accelerate its development. And we are already essentially doing other programs, which will include upgrade drilling to bring forward financing conversations. The reason for this is I mentioned this higher grade starter pit, and we've got a nice long section here that shows us what that looks like. This sort of stage 1 starter pit here, you can see, is concentrated in the center of the deposit and some of these shallow oxide material. And we have high grade materials in here and very high recoveries, up to 95%. None of this material is refractory. And the benefit of this is, again, that starter pit there can pay back the entire development essentially 2 times over in 1 year. When you go to include the S2 or the stage 2 pit, that adds another 165,000 ounces. So you're producing 365,000 ounces of gold, nearly 1 million ounces of silver, and $1.3 billion in operating free cash in the first 2.5 years. So that really explains why this is so attractive to sort of our banking financial partners. 50% of the cash that this project generates across an 8-year production profile is generated in the first 2.5 years. The other thing that this does is it gives us a really strong example of essentially the economic torque that you get to marginal grade in a high efficiency mining and milling operation. If you look at the table here that we've got on the bottom left of the screen, you can see when you've got sort of a life of mine average of around 5 million ton per annum going through the mill at an average head grade of about 0.8 gram, which is virtually identical to the Wudinna project, you end up producing 120,000 ounces per annum, which is the same as the Wudinna project. But that starter pit there has a grade of about 1.2 grams. So it's 45% higher. And the net effect is for a given 5 million ton per annum throughput, which for all intents purposes costs the same amount of money, whether it's one grade or another. You're not getting 120,000 ounces per annum. You're getting 200,000 ounces per annum. So it drives down the cost per ounce. And what that means is we get this very fast payback, but also we want to find ways to increase the average feed grade profile over time as we move through years sort of 5, 6, 7, 8, 9, and 10 here. And that's where we look at these Tarcoola projects that we have, the Wudinna project that we acquired, and we start to look at Tunkillia as our second regional hub for blending feed. When we go up 70 kilometers to the north to the neighboring Tarcoola project, that is South Australia's original high-grade gold field. That's where gold was mined at 30, 40, 50 grams per ton on our mining leases. And then we have an existing open pit, which is on the cover of our presentation, that produced gold at 3 to 4 grams per ton to our central Gawler mill. So we've identified a number of high-grade gold incidents here, but we've also made, in particular, one key target, a dual high-grade gold and very high-grade silver discovery. So this is the Tolmer prospect, kind of in the middle of that historical gold field. This started as a regional structural modeling exercise that we spent about 2 to 3 years on. We predicted some targets at the end of 2023. We drilled them in early 2024. And in August 2024, we announced the discovery of this high-grade gold zone I'm circling here. Now, we stepped out some more drilling. We extended it. We stepped it out. We extended it. And we were getting kind of up to 80 grams per ton gold here near surface. That was exciting. It got more exciting when we went back and actually re-assayed this gold for multi-element analyses. We were looking for ways to use geochemistry to model complex vein sets. And quite to our surprise, we discovered that we had silver up to 300 grams per ton, 300 grams per ton gold with 80 grams per ton silver. And that was a surprise because that's an inversion in the traditional relationship that you see in this gold field. Typically, you might see 1 part silver to 5 part gold. And this was 5 parts silver to 1 part gold. We then stepped about 500 meters to the west and drilled this target here. And this was a second interpreted structural target. And our first drill hole, as luck would have it, ended up being one of the 5th highest grade drill hole reported on all public exchanges in the first half of 2025. So we had an intersection of 6 meters at 4,747 gram per ton silver, or 28,000 gram meters of silver, but not across 200 meters like we see in some of the mega deposits, but across 6 meters and within 50 meters of surface. And what you see, that interval and some of the intervals around it are on this cross section on the right. Beg your pardon. On the right-hand side of the screen, we have this sort of shallow, thick blanket of silver mineralization starting from surface. So 10 to 20 meters of mineralization from surface. That's around 100 grams per ton. And then we have this lower arm of mineralization here that's down at the sort of interpreted transition zone between oxide and fresh rock material. And this is where we're getting 500 to 1,000, 1,500, 5,000 gram per ton silver. And our latest drilling has just identified that, in fact, there's a bunch of high-grade gold to this as well. So we have gold from 3 to 13 gram per ton gold with that high-grade silver. The blanket on top seems to be open and extending to the west. The high-grade arm on the bottom seems to be extending and open to the south and east. So we've drilled this with Aircore and RC. We are trying to work out now what's going on structurally. Clearly, if we have things going in 2 different directions, we've probably not drilled perpendicular to mineralization. The 3 red holes you see on this image on the left, those are diamond holes that we put into the sort of eastern gold zone where we know we are actually in hard rock structure to see if we can identify what's going on locally and then track in on this source of this mineralization. Because if we can find the source mineralization that's generating this type of gold and silver, we may be onto something really big. That could also obviously then blend into our existing and future Tunkillia mills. And then when we look to the south of Tunkillia, this is the Wudinna acquisition. We just acquired this in July. It has about 280,000 ounces of resource in it. Now, the resources here are open to growth. There are nearly 2 or 3 dozen untested targets around it. But what's really interesting about this project, again, is its development characteristics. It's shallow. It has strong gravity and CIL recoveries. It also is indicated to have pretty efficient flotation recoveries. So we are considering here, not only do we grow this, but we could actually produce a high-grade concentrate here, truck this up to our Tunkillia project, tip that in, and create more of these stage 1, year 1 and 2 style returns, where we're not producing 120,000 ounces, but a steady state 150,000 ounces, and driving down the operating cost per ounce. So a lot of interesting things going on here. And we're very interested to see, do we tip this into the Tunkillia plant, or do we send those concentrates directly to port? So really for us, a lot going on. The next 18 months is really about commercializing on both fronts here. One, getting that central Gawler mill into operations and getting production started. And two, bringing along Tunkillia in parallel and right behind it so that we can actually turn that project on as soon as possible. We're aiming for a mining lease application at Tunkillia by the end of 2026 as well. Hopefully we'll be able to get an approval during late 2027 or early 2028. And then lock in our financing and move directly into development to take ourselves up to a 150,000 ounce per annum producer. That is the abbreviated update. So I'm happy to take questions as you have them.
Okay, great. Yeah, I have several. I don't think we have a lot of time. We could spend 30 minutes doing Q&A, but I would ask that you keep your answers to short, 30 seconds, if you will, so I can get through questions. My first question is about Normandy, about your team. It seems like it's a pretty impressive team. You said that Normandy was a fairly large mine. When you sold that mine, how many ounces per year were you guys mining?
Oh, no. So we didn't sell Normandy. So Normandy Mine was owned by Robert DeCrepney. Our chairman was the CFO of Normandy Mining. Now, Normandy was producing about 2.5 million ounces per annum in 2002.
Wow, that's a big mine. Big company.
Global collection of many mines.
Yeah. 2.5 million a year. So your team is, it's a very strong team. That was the one point I wanted to make. So it looks like, we always knew that this was going to be a process. It wasn't going to happen overnight. So now we're looking at your phase 1 at Challenger. It looks like you guys are finally ready to kind of move on that, get into production in 26. But that's not where the money is. The money here is clearly in Tunkillia. And my first question on Tunkillia is the cost. I mean, you mentioned that you compared yourself to Capricorn, but the costs are nowhere close to Capricorn. You have an average of $1,450 US AISC, and theirs is under 1,000. So how do you how can you compare yourself to Capricorn in that regard?
So theirs is under 1,000 US in the current years where they're mining the shallower, softer material. That will increase over time. During our early years, we are also operating at actually under 1,000 Australian and then under 1,000 US. So it'll be roughly a similar profile. Right,
but they are a low cost producer. You will be a low cost producer potentially in your first and second year, but after that, you're basically a normal producer, if you will, a moderate producer. So I wouldn't consider you a low cost producer. The Capricorn comparison, I don't think it really holds water per se. I just wanted to bring that up because Capricorn is an elite miner. They are a low cost miner. But what you're trying to do here with Tunkillia is, I like the project. So Tunkillia, it only shows an 8-year mine life, but both of these properties, something you didn't mention, both of these properties that you have are large properties. They're both 300,000 acres combined. I mean, separate. Correct. Each is 300,000. So they're very large. I believe that you have drill targets all over the place. So Tarcoola, and then you have the Tolmer, and then you have Challenger, you have Tunkillia, then you have Wudinna. So you have like 5 different existing discoveries that you can expand on. And I think the Tolmer one is, I mean, you've drilled it north-south, but the east-west, you don't know, right? You said it's open to one area. So my point of this is like, yeah, it's a short mine life, but I basically don't think it's going to be. when you add up all the gold you're going to find, if you will,
Yeah,
I think that the key here is becoming 100,000 ounce producer, which is going to happen. It looks like, you probably do. It's going to take a while. 29. I mean, it looks like about 5 years out for Tunkillia. But once Tunkillia gets into production, you're going to be a 100,000 ounce producer and probably grow to 200,000 ounces over the next decade. So you're kind of a long-term play. So it looks like your first phase one Challenger is permitted. It's in the works. The capex is like $20 million. It's kind of a slam dunk, and that free cash flow is going to make it really easy for you to get to a construction decision on Tunkillia. And the one thing you did talk about is the capex on Tunkillia, and I like you to, because you are going to generate cash between now and the construction decision, but you're probably going to be able to borrow a big chunk of that, and so you're not going to dilute us too bad. But do you have any estimates on? You should have a fairly good idea of a range of what it's going to cost for the capex to build a mill.
We have a very good idea, and a couple of things I'll say on that. Yeah, that it's an 8-year mine life at Tunkillia, but that's there's another 20 kilometers of untested shear along strike from there. And in the numbers on Tunkillia, we've actually only studied the Tunkillia mineralization, so we haven't yet factored the addition of high grade mineralization from Tarcoola or Wudinna, which will actually drive those costs down. And we would actually expect to see ourselves in that 1,500 Australian AISC long term. In terms of the capital cost at Tunkillia, that's $399 million Australian. That's actually a PFS level buildup. So call it $270 million US. We expect that we'll fund that about 70% with standard corporate debt, and then the balance being equity, which we would be generating from our stage one operation. We could also look at forward selling the silver credits that are in there to fully fund the upfront equity component. So the idea of the existing Central Gawler mill, as you say, is it's kind of a slam dunk, but more importantly, it's a stepping stone to the bigger picture outcome, where when you combine Challenger and Central Gawler mill, with the first year of Tunkillia, we're producing closer to 250,000 ounces, and then steady state longer term between 150 and 175,000 ounces per annum.
Thank you. That's beautiful. So your insiders are very strong. One of the reasons why I like this project, your company, and this project is because of that. Your management owns 22%, which is fantastic. And your institutional holdings 30%, and then high net worth about 28%. My point is, no one's going to acquire you because you're too strong. You're not going to give this away. You mentioned you're going to try to convert this into a multi-billion-dollar company, and I believe that's in the cards. I have you as a possible 15-bagger at $5,000 gold. I think that's very achievable. So you're one of those companies that has a lot of upside. But with the strength of your management team and the strength of your insiders, would you guys, between now and 29, between now and getting Tunkillia into production, would you guys be looking, would you be looking to expand you've already did this one acquisition of Wudinna. Would you be looking to do another acquisition? Because I think it would be very smart for you guys to acquire a producing property between now and 29.
Yeah. So now that our stage 2 asset is on track, we're already looking past our stage 2 asset. And you're quite right. We've broken ground on some early M&A. So, I guess before I probably better scoot off here to another meeting. But the long story short is definitely we are looking forward our future growth. We're already building those pathways. We're always looking 3, 5, and 8 years out.
Yeah, this is a beautiful story. Glad you could be on, Alex. Glad that we could share it. I love the Aussies. I love the Aussie gold stories, and there's a few silver as well. But it was good for us to be able to get one of you guys on here so people can get a feel for this. I mean, you guys know how to mine. I mean, and in closing, let's let people know how mining in Australia is kind of part of your culture.
Well, look, I mean, it is very much a make it happen country. Australia is largely primary industry economy, so it's mining and agriculture. We essentially export the rocks that the world uses for a lot of things. We tend to have the advantage of established infrastructure and flat terrain. So whereas, a lot of really interesting deposits might exist in really hard to access areas, we are able to take deposits that are maybe, more middle ground average deposits and actually bring them into operations. We have a huge established labor force, skilled labor force, obviously established infrastructure, and a state and federal legal framework that is designed to facilitate mining and the export of commodities.
All right, beautiful. Thanks for being on.
Thank you for having me.
Thanks, Alex.
Yeah, I can summarize real quick. This is a really, really strong development play, but it's not going to happen overnight. This is a 29 story. We got to wait until 29 when they get Tunkillia up. But when Tunkillia, when they break ground on that, this stock's going to really fly. I mean, they're currently valued at 144 million, which is my sweet spot. I like to find development plays 50 million to 150 million that have billion-dollar plus potential. And that's exactly what this one does. I don't really like to, I'm always looking for alpha, of course, and I don't want to buy something that's pricey. And this one isn't. This one definitely has 10 to 15 bagger potential. And so it's got a lot of there. It really doesn't have any red flags. They've done a really good job of dilution. He just talked about how they're going to fund this mainly with debt, 70% with debt. They know what they're doing. They have a strong team. This Normandy management team, strong board. So this one of the things I like to do on development stories is make sure that they check all the boxes. And this company surely does. There really isn't any boxes that I'm worried about. The one thing that's usually missing in these stories is the plan, the path to production, how they're going to do it. But if when they tell you exactly what they're going to do, that really gives me a good feeling. Now it's just a matter of them executing. And then the second thing that's really important is the management team. They got a strong management team. And so I'm not worried about that. And so it really does check all the boxes. There isn't a lot of, the only thing that people are going to won't buy this company for is you don't get paid until 29. That's a long time. So a lot of people are going to avoid this stock because they don't want to wait until 29. And I don't really want to wait until 29. So it's a ways. It's 5 years out. But
I would argue, and I get you. I do understand that argument. But I would argue, we just had gold break 3,500 with authority this week, right? And silver break 40 with authority. And the miners are following suit, but in greater percentage gains, right? And some of the things that we've been talking about, Don, I remember, we were talking about CDE at $6 before it broke out to 9 and kind of consolidated there, and now it hit 14 today. And we sold a little bit at $13.99 today because I said, look, I'm in at 4. This thing is going to rock and roll. But I have a different, processes than you. I've got a lot of people that follow my trades, and so I've got to make them money or else they won't subscribe, right? So I want to make sure people are making money along the way because the RSI on that got to 83 today. And, we're getting a little stretched in some of these names. But with Barton, what I was saying was that the gold price breaking out caused a couple of major banks to already talk 4,000 gold. Whereas when we started at the beginning of the year, we had a handful of guys around 3,500, but now we're seeing 4,000. I saw a guy interviewed yesterday at 10,000 on Kitco, who I've never even heard of before. We're starting to see some crazy gold numbers. So they could be going into production at almost the exact right time, right? We're at 28, 29, 30. I'm not hearing much about gold peaking until 31 or 32 from what I read.
Right. What I was talking about getting paid, I'm talking about the 10 to 15 bagger. Now it definitely will. It will definitely trend higher with everything else. The rising tide is going to lift all boats. It's going to do well. But to get if you buy it to get a 10 bagger, you're going to have to wait a little while.
Yeah,
that's the only point.
Yeah, gotcha. So BGD is the main ticker on this stock, Barton Gold. Everyone, BGDFF is the U.S. ticker. Alex and I have talked off camera a couple of times about their U.S. ticker, and I know he's worked diligently with the OTC to try to fix things. It's sometimes difficult when you have a newer OTC listing to get a decent bid-ask spread from the OTC. I will caution people that that is the case with this stock, that you cannot just put a market order in. You will get slammed on an execution. So you have to be careful and methodical about it. But here's the upside, right? Don and I interviewed Alex February of last year, so a year and a half ago, almost to the day. We interviewed him around 15 or 17 cents US. This thing's at 61 close, and I would argue it's going to go a lot higher than that because, again, voluminous bid-ask spread. It could print at 80 literally next month for all I know, because someone puts a crazy order in the middle of that spread. So the good news is Alex is aware of this. He's trying to work on it. I think with higher gold prices come better bid-ask spreads on all stocks, and this will be included. So
one final thing, and then we'll close it out. I just want to mention for Australian stocks, what I do is I found a brokerage, an online brokerage that basically caters to international ordering. And It's Interactive Brokers, IBKR. Yep. So Interactive Brokers, it's free to sign up. It works just like all the other online brokerages, but you can buy stocks in Australia or London or Canada. But what you want to do is you want to buy them in the local currency. So you buy them on the Australian exchange using the Aussie symbols, but you buy them in Australian dollars. And the reason why you do that is because you buy them in US dollars, it's actually considered a margin acquisition because you're holding them in dollars. So if the dollar goes down, you get a margin call. And so, but I actually think that it's better to hold them in Aussie dollars because I think the US dollar is going to go down. So I like these Aussies and Aussie dollars and Canadian dollars because I think the dollar is going to go down. So we're actually getting a discount when you buy them in these currencies. So I'll just end it there.
That's a really good point, Don. I've had a lot of clients use Interactive Brokers. It's a little wonky in terms of not knowing what your commission is going to be, because I think the way they used to do it was, hey, if you want to put a big order in, it'll cost more. If you put a small order in, it costs less. I prefer Fidelity. Fidelity has been really good to me the last 3 years. I put a lot of clients there because they charge $0 on OTC stocks. This one would be different, however, because when you're dealing with some international stocks, Fidelity charges what's called a foreign settlement fee of $50 per trade, and it's really annoying, but it is what it is. I mean, I kind of look at it like there are three or four or five stocks that I could trade at E-Trade or IB, and this being one of them, right? And the rest I can trade at Fidelity literally for free. So why that helps everyone is if you get, let's say you're trying to do what Don and I do and not chase a stock, right? You're not going to hit the offer. You're going to sit there a little above the bid and try to get filled. Well, if you get filled on 1,000 shares and you're trying to buy 100,000 shares, you will get a $7 commission at some places or a $10 commission on that partial fill. So that's why I moved to Fidelity 3 years ago, because I kept getting these partial fills on juniors, and it was so annoying to get charged, $7 on $1,000 trade. So.
Yeah, the thing to do is to have both. I have Fidelity and IBKR. The thing is use both, and then you buy whichever is the cheapest, right?
Right, exactly. It's good to have two accounts always.
Right. One nice advantage of IBKR is that when you deposit money in, you can spend it immediately. I mean, within seconds. I really like that.
Yeah, that's great. Yeah, we still have a lot of people in the general market using things like Robinhood and stuff, and it's just, I mean, it's good for a beginner, but you have to get a better platform at some point. And I don't really like Schwab. I think they're very snooty. I think their service has really fallen off a cliff ever since COVID. I mean, that's why I moved from TD, which I believe their active trader version, which is called Thinkorswim, is fantastic. That's the only thing I really missed, but their customer service was awful. So Fidelity's been really good to me. And I've encouraged people to look at that for $0 trades. And also for what Don's talking with IB in terms of international stocks, because it does make a difference.
I think diversification is important too. I mean, I don't like to have everything in one account.
Well, here's an example. We got to go, but here's an example of what can go wrong, right? 9/11. There was so much volume when the market opened up that I had a Merrill account that was frozen 30 minutes into trading. And I had most of my money in that account, and it didn't reopen for 4 hours. I mean, you're sitting there with limit orders that you placed in the first 30 minutes of trading. And I got filled on a bunch of stuff because it was so volatile. And I went back to Merrill and I said, hey, you got to work with me here. And they did, but it wasn't until I argued with them over and over again that they actually acquiesced. I mean, it was pretty scary. So, having at least two accounts at different, one here, one there, I think makes sense. So we'll wrap it there, Don, and we'll get to our next interview shortly. For those of you that want to check us out, remember, we're at Beaver Creek September 9th. We'll be there the whole week, September 9th through the 12th. That's Beaver Creek, Colorado. Don and I are fortunate enough to be two of the 13 speakers there, so we hope you check us out or check out the videotaping of that on precioussummit.com. And thank you for joining us today.